Welcome back to all our viewers. Welcome to our regular NFO series where we speak with the top management and fund managers of the AMCs to understand the new fund that is coming into the market. We understand what are its features, benefits, and insights on why this fund, is particularly worth investing. And today we will be discussing the SBI Quant Fund. The NFO period has opened on December 4th, 2024 and will continue to remain open until December 18th, 2024. Today, we have with us Mr. Ganesh Kamath from the SBI AMC to talk more about this fund. He's the chief manager for products, has over 12 years of diverse experience spanning across sales, product development, and communication within various product categories such as mutual funds, PMS, that is portfolio management services, and alternative investment funds. He is a certified financial planner and currently heads the product ideation strategy at SBI Mutual Fund. Welcome to the talk, sir. So good to have you here.
Thank you so much. Pleasure.
Okay, so without much further delay, I will jump right into this question. Is that how does the SBI, multi-factor model for this SBI Quant Fund dynamically allocate across the momentum, value, quality, and growth factors, and what makes this approach unique?
We have come up with this NFO SBI Quant Fund from December 4th. It has started, and as you said, we are focusing on the four factors, which is quality, momentum, growth, and value. We dynamically manage this because this is called as a multi-factor model. And as the name suggests, we will be allocating our assets across the four factors. And we will not concentrate only on a single factor. And that is the beauty of this product. So basically, across different cycles, factors has a tendency to perform, in a downturn phase and even in the expansionary phase. So we don't want to be dependent on only one factor. We have benchmarked this fund with BSE 200 index. So what we will do is we have a universe of 200 stocks, and it is ranked on each of these factors. So each stock will be ranked on each of these four factors which you mentioned. So by diversifying all our stocks, the entire portfolio basis these four factors, what we do is we are aiming to smoothen the cyclicality of the returns. And this helps us to mitigate, the behavioral bias, unlike other active funds where the fund manager might be biased towards a particular factor. So this tries to mitigate those behavioral bias. Because just to quote an example, before COVID, quality stocks were doing extremely well. And, post-COVID, value stocks started performing and value investing came back.
Correct.
So in Indian markets, it's very difficult to identify what is going to do well in the next phase of equity cycle. And that's why we are not going to, really single out on only one factor. Of course, whenever a particular factor does well, the performance does well, the weightage of our four factors will tilt towards that particular factor. So that's how the entire portfolio is constructed.
Okay. So then how does the model adjust during the different market phases, such as expansions or downturns, to optimize the alpha, to optimize returns as such?
So what has happened is, as you may know that, during expansions, normally like momentum or growth stocks do extremely well. Whereas in case of downturns, quality and value starts to relatively perform better. So our model evaluates and ranks stocks across all the four factors, as I said, and we arrive at a composite combined rank. And whichever stocks get the better rank, they have a chances of being a part of that portfolio. And we adjust the weights depending upon the, its relative weightages in the benchmark as well.
Correct.
So based on these composite rank, the portfolio is proactively adjusted on a monthly basis. So what has happened is we try to rebalance this portfolio on a monthly basis. So we don't miss out on any factor performance. We don't miss out on any prevailing market conditions which is currently going on, because we readjust this portfolio on a monthly basis. And whenever we readjust the factor ranks, what happens is you are very proactively managing the portfolio to capture the right right opportunities in that current phase. And that's why, when we follow this quantitative rule-based approach, the model completely eliminates the emotional decision making. Unlike your active funds, where where of course there are pros and cons of both the types of investing, but here you follow a disciplined factor rotation, and that's why it avoids any pitfalls of chasing recent trends or abandoning any underperforming factors prematurely. So it is a rule-based approach. Yeah.
Okay. Okay. So my next question is that what are the different predefined risk constraints such as tracking error or liquidity that are considered during the portfolio construction?
So, we have sought to include predefined risk constraints in the final portfolio construction process, and to avoid any possibility of, excessive concentration to a particular stock or, for that matter, a particular sector, and also to manage the illiquidity of a particular stock. So, to ensure that portfolio doesn't have excessive concentration towards a single stock or a single sector, we have included in this model that the active stock limits, active sector weights, and also the tracking error limits. So the use of this rule-based framework ensures that the portfolio remains very agile, very nimble, and it is responsive to any market conditions as we foresee. So that's why for this to be implemented, the liquidity of the portfolio is of paramount importance, and hence we also consider, whenever we have designed this entire framework, we also considered impact costs and stock liquidity while constructing the portfolio.
Correct. Sir, I think you did mention that the portfolio will get churned every month. So I think that answers my pre-answers my question that how frequently does the portfolio get rebalanced. But I want to know more about the triggers behind the rebalancing decision. That it's a quant model. So, and you mentioned the four different parameters. Now, what are the different trigger points that are in place, which may, is it like all four trigger points must be triggered or, one of them, or how does that work?
So what happens? Yeah. So what happens is a very valid question, in fact. So what happens is, since we have four factors, four broad factors, and within those four factors, what we have done is, so how did we design these four factors? Basically, we reached out to our fund managers and we analyzed, what do fund managers look at in identifying a particular stock in their portfolio. So for a momentum perspective, they look at 52-week price highs. Similarly, from quality, they look at the consistency of earnings, the free cash flows, and the corporate governance. So a lot of these factors which has undergone in these broad four factors. Now, once we determined these four factors, under what circumstances do the rebalancing happen? So see, we do not rebalance on an ad hoc basis. We rebalance the entire portfolio on a monthly basis. When I say rebalancing the portfolio, it means that there won't be like a major churn which may happen, because out of four factors, value as well as you can say momentum, there is a price component which is attached, and whenever the price changes, of course these factors might undergo few changes, and accordingly there might be changes in the factor ranks for a particular stocks. There might be changes in the factor weights, because as I said earlier, whenever a particular factor starts performing well and there is a increase in the performance trend, the algorithm which we have set in might increase the factor weights to that particular factor, and that's how the entire process works. So ultimately, as I said, we are very proactive. The model is very proactive in identifying the trend, and accordingly it will increase the weights towards that particular factor.
Okay. The next question is, related to the risk and the performance of the fund. I mean, so the first question is that what are different mechanisms that are in place for the fund to ensure that there will be a smooth and faster recovery from the drawdowns? Inevitably, we will face certain things here and there. So, what are the mechanisms that are in place?
So, as I said earlier, we will not be skewed to a particular sector or stock because there is no human intervention. So, to protect any concentration risk, of course, see, any sector or stock weightage is nothing but the derivative, the outcome of whatever the stocks the model throws out. And whichever stocks that throw out and it get classified into a particular sector, it may be the result of that. So, for example, in current scenario, we think as a fund house, and even the model is indicating that quality might do well going forward. So you might see a few sectors like IT and pharma might have certain stocks which have a quality rank on a higher side. So you will see a tilt towards IT stocks in comparison to other sectors, and that is a possibility. So we have tried to mitigate any poor performance of a factor. Of course, there since the entire objective of the model is to outperform BSE 200, as well as to give you that reasonable alpha over BSE 200. So the entire objective, to achieve this objective, what we aim is to smoothen out any sort of volatility in a particular underperformance of a factor. Yeah.
Okay. So then the next question is about how does the fund manage sector rotation and market cap allocation to adapt to the changing economic conditions?
So as I said, I gave an example of quality. So if quality as a factor is doing well, and tilt towards IT as a sector has higher weightage, it is just the outcome of that higher quality rank. And on a market cap basis, since this is benchmarked against BSE 200, and
Correct.
in fact the model whole portfolio models universe is also 200 stocks.
Correct.
So you will see a lot of large cap kind of a concentration in this particular portfolio, which is really very good, because large cap is presumed to be more safer, and historically it has mitigated a lot of drawdowns. So this helps. It helps to provide more stability to your overall portfolio when you invest in this fund.
Okay. So there are a lot of quant funds out there, compared to the other quant funds that are coming into the market. I mean, there are some NFOs that are also there. There are some existing quant funds. What are the other distinctive features that sets this SBI Quant Fund apart and adds the additional, that extra value for the investors?
So basically, how I would see it as, we have analyzed a lot of other quant funds as well in the market. And what we could filter out is we have identified two types of major differences, two kinds of those portfolios, where where one part of the portfolio is like, the one section of funds is ideally following, they are trying to filter basis a quality factor initially. And then they are trying to assess all those filtered quality stocks basis all these four factors. Whereas the other set of section of funds, what they do is they have more biasness towards momentum, which is also a risky. Like momentum is highly volatile. What we as a fund house in this SBI Quant Fund we intend to do is we are completely giving equal weightages in the beginning. We will be giving equal weightages to all those four factors when we rank the individual stocks. So when we rank a particular individual stock, we will give equal weightage of 25, 25, 25%. And as and when the portfolio gets constructed, the portfolio is live over a period of time, as in when the particular factor starts performing, as I said, the factor weights automatically gets increasing. I mean, it increases over a period of time. And then what we have done is we have defined the upper band and a lower band limit. So upper band is 35%, lower band is somewhere around 18%. So whenever one single factor, any one of the single factor touches upper band or reaches a lower band of 18%, we then try to rebalance it to 25, 25, 25 again. And that is what is, so we are trying to achieve this balance, right balance when we are constructing the portfolio.
Okay. So the last question actually would be, who is your ideal investor? I mean, who can be the good investor for this particular type of fund?
So basically, when I assess, when we were launching this product, we ideally thought, and in fact, we evaluated the market scenario. This is not a fund where one can time while investing. This is nothing like, someone can time, they can find an ideal time to invest in this particular portfolio. It is nothing ideal. So this fund, we consider it as an all-weather fund, basically.
Okay.
Why all-weather fund? Because since we are investing, so when you look at a multi-cap fund, it is similar to an all-weather fund, right? Because you are not timing any particular cap. आज मैं small cap में डालूंगा या फिर I will be investing in large cap. Multi cap fund is a one stop solution where fund manager does it all for you.
Correct.
Similarly, this is a multi-factor fund where
Yeah.
model has invested across, you have momentum, value growth, and quality. So all these four factors where we give due weightages.
Correct.
All these four factors does well across market scenarios. Two may not do well, two may do well. So
Yeah.
you're not timing anything. The fund does it for you. And this is we consider as a one-step solution. And of course, the fund is suitable for all those investors. Since this is more like a large cap bias, the fund is suitable towards those investors who have, who want a more of a large cap, stable kind of an exposure, who want to invest in the, sort of a more stable market cap kind of an approach in their portfolio. This is something which they should look at.
Sure. Thank you so much, sir. Thank you for giving your time and helping us understand what the SBI Quant Fund is all about. I would again like to reiterate for our viewers that the NFO period starts from December 4th, 2024 and will continue to remain open till December 18th, 2024. We wish you all the very best, and hope that the fund opens to a great market response and gets oversubscribed.
Thank you so much.
Thank you so much, sir. Hope to speak to you again.
Thank you. Thank you.
Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.